Investing in equities? When you opt to invest rather than save your money,
You should also bear in mind that there is more than one investing strategy.
so, are you aware of your investing strategy? If you are like most investors, you have probably not given it much consideration. Nonetheless, learning the fundamentals of the major investment types is one of the quickest ways to make sense of the tens of thousands of products currently available. You have come to right place. This video will talk about 10 investment styles every investor should know about. Watch this video till end so that you don't miss any important information. When it comes to achieving your investment goals, asking the appropriate questions might help you select which road to take. Before moving further, please subscribe to our YouTube channel and hit the L icon for upcoming alerts. Number 1. Active investing. If you are ready to take on more risk and keep a close watch on market patterns and movements, an active investing technique may be ideal for investing in stocks. Active investing is typically undertaken by individuals who are more concerned with the today than with the future. This strategy entails choosing certain stocks and employing market timing to outperform the market in order to achieve short-term profits. Because active investing involves more frequent and short-term buying and selling, it typically has substantial tax and transaction cost consequences. Number 2. Passive investing. If you are more risk-averse and do not want to spend your days monitoring the price movement of any stock or index, a passive investing approach may be for you. Passive investors invest their money over time. Rather than attempting to time the market, passive investors construct portfolios that mirror a market-weighted index. Because of the diversity, monitoring an index typically results in reduced risk and lower costs due to low turnover. Number 3. Growth. If investors feel that a business will expand in the next years and that a stock's intrinsic value will rise, they will invest in that company to enhance its corpus value. Another word for this is growth investment. Short-term ownership is chosen by investors who believe a firm will deliver high value in a year or two. The holding term is also influenced by investor choices. For example, how soon do they need money to purchase a home, send their children to school, prepare for retirement, and so on? Number 4. Value. Worth investing entails investing in a business based on its inherent value. When the market corrects, the value of such undervalued enterprises will be adjusted, and the price will skyrocket, providing investors with huge profits when they sell. This strategy is used by world-famous investor Warren Buffett. Number 5. Indexing. Indexing is another popular approach to invest passively. An investor who employs this method creates a portfolio that closely reflects the firms that comprise a given stock index. They want their portfolio to outperform the index. This form of investment may be a good option if you desire a straightforward and low-cost plan for building a broad portfolio over time. Because of the lower turnover, the transaction costs and taxes involved with managing these portfolios are exceptionally low. Indexing is accomplished by investing in index mutual funds or exchange-traded funds that mirror the performance of a benchmark index such as the Nifty 50 or Sensex. ETFs are often less taxed and less expensive than regular index products. Number 6. Buy and hold. The buy-hold approach is another example of passive investment. An investor that invests in buy-hold securities will not modify their portfolio regularly. They aim to develop in the long haul. The idea behind buy and hold is to invest in a company when its price is still cheap in order to benefit from the stock's price growing over time. Number 7. Market capitalization. The term market capitalization or capitalization refers to the measurement of a company's size. Market capitalization is calculated by multiplying the number of outstanding shares of a firm by the share price. Some investors believe that small-cap firms should be able to generate superior returns since they have more growth potential and are more agile. However, the possibility for higher profits in tiny caps comes with a higher risk. Smaller businesses, for example, have less resources and sometimes have less diverse business lines. Share values may move considerably more wildly, resulting in considerable profits or losses. As a result, investors must be willing to accept this increased degree of risk if they want to capitalize on the possibility for higher profits. Number 8. Dividend growth. Dividend investment,
often known as income or yield investing, seeks to produce a consistent source of income.
high dividend yielding stocks are often extremely lucrative,
but their growth rates are frequently modest. As a dividend investor, it is your responsibility to identify companies with a high yield that will be able to pay dividends in the future. It would be much preferable if the firm could increase its dividend yield.
Dividend investing strategies are about more than simply profit.
If dividends are reinvested,
a yield portfolio, for example, may experience large capital growth. Dividend-paying corporations are often profitable, which makes them defensive during downturns. Number 9. Momentum investing.
Movement investing is similar to growth investing in that it looks at the stock's price momentum rather than earnings or sales growth.
According to data, the best performing equities in one period may outperform in the next. Thus, price action alone is employed to determine purchasing and selling choices. However, it does assist in avoiding tiny and illiquid firms. A straightforward momentum strategy would invest in 10 to 20 of the best performing stocks and hold them for a year. At this point, all stocks are sold, and the process is repeated.
More elaborate versions of the method will continually rotate money into the stock with the strongest momentum on a monthly or quarterly basis.
Number 10. Multi-asset investing. Stocks often give the greatest long-term profits. Nonetheless, they are the most volatile asset class. Investing in many asset classes may result in greater risk-adjusted returns. The more asset kinds in an investing portfolio, the lower the volatility and portfolio risk. A well-diversified portfolio may include stocks, bonds, cash, commodities, real estate, hedge funds, and private equity funds.
There is no investment strategy that fits all situations.
Your risk tolerance, investment horizon, age, and objectives will determine the optimal option for you. We hope that you found this blog to be informative and that you will apply the information in the real world.
Please also assist us in promoting financial literacy by sharing this blog with your family and friends. These were the 10 investment styles every investor should about.
If you enjoyed this video and want to hear more from us, like this video and subscribe to our channel. See you in the next video.